So let's have a look at the different types of charts that you can use in order to do your technical analysis. Just to really emphasize that this course is going to be focused on candlestick analysis, but there are other charts that you can also look and explore. The first one we're going to look at is this one, which is the open high low close bar. Okay, so as specified, OHLC bar displays the open, the high, the low and the close of any given time frame. So this is what it looks like right here, and the way it works is if it closes higher than the opens, then it will give you the little bar here. For example, if we take this candle here to the right, and this shows you that this is where it opened, which is to the left. If it actually closed lower than it opened, then it will, let's find one that looks like that. So it will actually look a little bit more like this one. Okay, so this is like a high test bar. For me, this is a little bit difficult to read, and I wouldn't waste too much time using this, because it's a lot easier to see how the psychology of trading when it comes to using candlestick analysis. The other type is a line graph. So this actually just simply connects the closing prices, so it doesn't take into account the noise of the market, but this actually just shows you where the market's going using the final closing price of any given time frame. You can see it's just shown here by this line. Finally, candlesticks, and this is what we're going to focus on. So this also shows you the high, the low and the open and the close, very similar to the OHLC bar, but in my opinion much easier to see and much easier to actually interpret using this information. So how it works, I'll show you in just a moment, but basically the key difference between the two is that here we use colors to actually show you where the market has actually closed lower than the open or closed higher than the open. So if the close is lower than where it's open on any given time frame, so for example, if it started the day here as an example, let's say this is a day chart, but it closed here, which is shown by the body, then it's shown in red. And if it opens and closes higher at the end of the day, it's shown in green. I'm going to just show you how that looks in the next slide. So this is what you must learn to understand and interpret charts. The wicks show you the low and the high of any given time frame. Very important to understand that this is any time frame. So it could be a 5-minute chart, an hourly chart, a daily chart. This is the high, this is the low, here is the open because it's green. Because the close is higher than the open, it's indicated in green. So in other words, the body is green when the close is higher than the open. If we had closed here and opened here, this would have been red. And this is what is shown here on the right hand side. Again, the wicks show you the high and the low. This is where it closed, this is where it opened, because this is red. If you compare that to an OHLC bar, this is what it looks like here. You can see where the close is here and the open is here. This is what it would look like, and here the open and the close is like that. So in other words, the close on the right hand side, the open is on the left hand side, but for me it's so much easier to see using the candlestick formation here. So make sure that's really clear. Make a note of it, pause this video, make sure you write those notes down so you're really clear what this means, and so otherwise the rest of this will, you'll struggle to make sense of it. So using that, there are actual candlestick patterns that will that you can use, and we'll use this throughout the course. Okay, generally as a rule of thumb, a bullish candle generally has a closing price near the high of the bar. A bearish candle is the opposite, with a closing price near the low of the bar. Price trend analysis is used by traders to give an enhanced context for the above rule of thumb. The location in the trend is always an important consideration. So these are examples of bullish candle formations. So starting with this one here you can see the market opens the day. Let's just assume these are all day trades. Okay, daily charts. Opens here. It eventually goes down, but eventually by the end of the day it closes up here. So if you think about this psychologically, what's happened here is you've got the bulls versus the bears pushing it down, but the bulls pushing it up, but eventually the closing price actually tells you who has won that day. In other words, the bulls here have control because we've closed higher than where we've opened, and obviously the bears tried to push it lower, but they failed. This one again is very, very bullish, where you don't even have any real push from the bears. In other words, the market opens and then the bulls completely take control and push it and close it up here. This bar is a little bit more of a battle. You can see it opens here, the market gets pushed down by the bears. They think that they're winning the battle, but by the end of the day the bulls again win that battle, and that's a nice low test bar where you expect the market to continue higher. So all of these are in context of the trend. So what you've got to remember is, we just get our pen out, is that you would expect this on, say, a support line. Okay, you expect these kind of candles on a support line. If you're in a downtrend like this, then really any kind of bullish candle formation will probably find some sort of resistance. So if you had a bullish candle formation, say at this area here, it will probably just find resistance and continue its path down. So trend context is very, very important, so make sure you write that down. So trend context, and we'll have a look at how trends work in the next couple of sections. The trend context, so write that down.